Thanks everybody for coming to our joint seminar series again, Capital Market Development, China and Asia. Today we're very happy to have Hanming Fan to talk about the repo haircuts in China, and our discussant will be Arvind. Hanming, you can start.
Thank you very much, Zhiguo and Bernie, for organizing this great webinar series. And I'm very pleased to have this opportunity to present this early stage work with Yongqin Wang at Fudan University and Xian Wu. And I'm also very much looking forward to the discussion of Arvind. The project is in early stage, and we really look for guidances of how to proceed. So as Zhiguo said, the topic of today's talk is determinants of repo haircut, collateral risk, and counterparty risk. So I'm a new entrant into this literature, so quite a bit of interesting reading of to catch up with what others have done. It's repo market is an important source of wholesale funding for financial institutions. The haircuts, or sometimes it's also related to margin, another terminology that refers to isomorphic thing, plays an important role in financial stability, both in theory and empirically, right? Theoretically, a haircut has been related to credit cycles, liquidity spirals, and leverage cycles. And empirically, haircut fluctuations has been linked to the collapse of the US repo market during the great financial crisis. And empirically, of course, there are well-known determinants so theoretically, there are well-known determinants of repo haircuts, including collateral risk, counterparty risk, and maturity risk, etc. However, empirical analysis of repo market is often constrained by data availability. In fact, in most countries like the United States or EU, transaction level data of repo is proprietary. So typically, the papers in the literature will be using the proprietary repo transaction data of one bank or one dealer to engage in empirical research. So what we do in this paper or this project is to use a universe of transaction level data from China's interbank repo market from January 1st of 2019 to April 30th of 2020 to explore the determinants of repo haircuts in the Chinese financial market and Chinese interbank market. So I guess one contribution is to bring in this unique transaction level data, very rich data, into this literature, and we are looking for guidances in terms of what questions that may be of great interest to experts in this field. And the second thing we'll do here is we'll also exploit two unique events that happened during our sample period. One is the Bosang bank takeover. Bosang is one of those city banks in China that was taken over by the Chinese Bank and Insurance Regulation, CBIRC, on May 24th on some concerns of severe credit risk. And also that happened on May 24th of 2019. And we also explored the onset of COVID-19. And we think that the Bosang bank takeover can be thought of as a shock to counterparty risk. And the onset of COVID-19 could be thought of as a shock to the collateral risk. Okay, so the paper now is very much descriptive in the sense that we introduced quite a bit of descriptive data statistics related to the Chinese repo market. I thought it's still useful for given the importance of the Chinese financial market, it's useful to give a good introduction of the repo market in China to the audience. So repo in China, there are two repo markets: interbank market, exchange market. Today's talk will be focusing on data coming from the interbank market, the panel A. And within interbank market, there are also several types of repo: pledge repo, repo, outright repo, X repo, and D repo. Here, we'll be focusing on pledge repo. Pledge repo is a dominant form of repo transactions. And the pledge repo are repos where the repo buyer, which is basically the lender, will take possession of the collateral, but not ownership unless default occurs. And the repo seller, which is the borrower, will get the pledge collateral back at the end of the repo agreement, provided that there's no default. Right, so it's only a pledge, not outright sale of the collateral to the lender. Okay, and in terms of the importance, pledge repo accounts for about 90% of total interbank repo transactions in China. In terms of magnitude, huge. 2019, the total interbank pledge repo volume is 745.5 trillion yuan. Right, so we are talking about a huge number. And outright repo is a mere 9.6 trillion yuan, and X repo 64 trillion yuan. So we are talking about lion's share. The pledge repo is really 90% of the total interbank repo transaction in terms of volume. So what is a repo transaction? It's a short term for repurchase agreement, right? So basically, the repo transaction can be understood as this, right? So the buyer, or basically the buyer of the repo, is essentially lender. They get the collateral received, and the seller of the repo are basically the borrower. They give the collateral, and the repo agreement will basically consist of 7 items. Who's the borrower? Who's the lender? What's the amount of money we are talking about? What is the maturity? 1 day or 14 days or 7 days and so on. What is the collateral being used in that transaction? Could be a basket of bonds or could be a single bond. What is the repo? What's the interest rate? That's called repo rate. And for each bond in the collateral, there's something called haircut. So for example, if the bond is worth 10 yuan, if the haircut is 20%, then that 10 yuan of bond will only be exchanged for 8 yuan of lending. Okay, that's called a haircut. Of course, there's a date as well. When is the transaction date? Okay, and the pledge repo are bilateral. It's not a centralized exchange system. It's bilateral negotiation. The ownership of the collateral does not change. The seller still maintains the ownership of the collateral. It was just being, withheld by the lender during the repo agreement. Collateral, as a result, cannot be rehypothecated, meaning that the lender cannot use the collateral received from the borrower to rehypothecate, meaning using it again, recycle it as a collateral for its own borrowing. Okay, so these are the 7 items for repo contract we observe in our data. And in terms of participants, this is a way to think about the Chinese interbank market. The central bank on the right, you can think of that's like a water main, right? That's where the liquidity comes into the house. The house includes policy banks, state-owned banks. These are big banks that can directly get water, right, liquidity from the central bank through standing lending facility or medium term lending facility and so on, right? The central bank opens spigots or the water valves to those big banks, policy banks and state-owned banks. Then these big banks will try to use the interbank market to basically liquidate the rest of the financial players in the financial market, including joint stock banks, city banks, rural banks, credit union, and so on. Then these small banks, on the one hand, will borrow money, or through these repo transactions from joint state banks and policy banks, state-owned banks. Then on the other hand, will lend money to the non-bank institutions like security firms, mutual funds, bank asset management, wealth management, and so on. Right. So basically, that's how the financial system, the central bank, injects or sucks up the liquidity in the financial system, right, through lending facilities that operates with policy banks and state-owned banks. then the big banks will use the interbank repo market as a source of wholesale funding for other players in the market. Okay, and in terms of the total collateral value by bond type, you can see that the main collateral being used in these repo transactions are policy bank bonds, treasuries, interbank deposits, and so on, right? But policy bank bonds and treasuries are the most common collaterals used in the Chinese bank repo market. In terms of collateral distribution by borrower type, it varies, right? So different borrowers uses different collaterals. Bank borrowers mainly use policy bonds and treasury. Non-bank borrowers more likely are going to use corporate bonds and financial bonds, right, as collateral. Again, in terms of lender by lender type, the kind of collaterals accepted by different lenders also vary. Large bank lenders tend to accept policy bonds, treasuries, and interbank deposits. Small bank lenders also accept corporate bonds and financial bonds. Non-bank lenders, they accept corporate bonds and financial bonds mainly. Okay. In terms of repo term, that it's basically in China, 80%, over 80% of the repo transactions are overnight repo, just basically 1 day. RO1, that's maturity date of maturity of 1 day. Okay, then followed by 7-day and 14-day. Basically, almost all of the repo transactions in China has maturity less than 14 days. Okay, so haircuts. So the data is coming from Chinese foreign exchange trading system, CFETS system. In that data, so all the repo transactions in China need to be recorded in a central system. That's where the data is obtained. And in that data set, the repo haircuts is not directly reported. Instead, for each bond in the collateral basket, the discount rate of bond face value is recorded by traders, right? So basically, this discount rate is basically up to capped at 100, but it's basically the following, right? F is a face value of the bond. C is the bond market value, and one minus H. H is the haircut. The face value multiplied by 1 minus H is how much money that the borrower is receiving for the bond that is has a face value of F. So we can do the inversion and calculate the haircut to be equal to 1 minus D times F divided by C, and of course need to do proper adjustment given that the discount is capped at 100%. Okay, in terms of repo haircut, this is the raw distribution histogram of the haircut distribution, and over 95% of repo haircuts is less than 20%, and over 80% of repo haircut is less than 10%. It is bunching at 0%, 5%, 10%, and 20%. And repo haircuts in general increase with repo term to maturity. I won't show the graph, but it's not surprising that repo haircuts increases with maturity. And municipal bonds on average have the lowest haircut. That's actually quite surprising. Are even lower than treasury. Haircut increases with rating as rating of the bond deteriorates. Haircut also increases with the bond maturity. If the bond still have many years to maturity, the haircut is higher. That is consistent with Duffy's theoretical prediction, because longer the maturity, the more sensitive the bond is to interest rate risks. Haircut is lowest among transactions between small banks. That's also puzzling. We will show that later more in regressions as well. Non-bank lenders require higher haircut than bank lenders. Large banks borrowers on average receive lowest haircuts. So the literature.
Just making sure that you have 10 to 12 minutes.
Yes. Okay. So the literature kind of talk about the collateral risk, counterparty risk, and maturity risk, all gonna come to affect the equilibrium levels of repo haircuts. I'm gonna very quickly describe a model by, not by us, it's actually cheaper tariff 2021 model of repo rates and haircuts. And it kind of illustrates nicely how the repo interest rates and haircuts are kind of levers that are moving different parts of the contract between borrowers and lender, and how are they jointly determined, right? So a model with two periods, t equal to 0, 1, borrower would like to invest in risky investment project. If the investment is risky in terms of return, being binomial, with probability p, the return is 0, so it's gonna fail. And with probability 1 minus p, the return will be low, which is positive. The investment can be scaled up. Okay, so $1, $2 investment, they are all fine. It's just linear in terms of total returns. There is a big main assumption that borrowers' belief of the project being failing, the P for borrower and the P for lender are different. Borrowers are more optimistic about the project than the lender. So the divergence in the belief about between borrowers and lender in terms of the failure probability of the project requires that it ensures that the borrower may think the project has a positive net present value, but the lender does not. So lender feel like he needed to have some collateral to protect its lending, right? The borrower has the pledgeable assets with current value equal to 1, the date 1 value when the project is uncertainty resolved. However, of this pledgeable asset is random, with the indicated by random variable R, and this R, it has a distribution F, and that's a common distribution for both borrowers and lenders. The borrower and lender, they differ in their belief about the success probability of the project, but not in their belief regarding the return of the asset, a return of this pledgeable asset in the next period. And so, as I mentioned, the borrower are more optimistic, and the lender needs to basically decide, how much, what's the interest rate to charge for the lender when the lender uses this $1 of pledgeable asset to borrow, and how much money to lend against that collateral that's valued at $1 today, right? So 1 over M basically is equal to 1 plus H. So in this model, a haircut is defined by this. So what you can quickly write down the borrower's expected payoff as a function of the repo rate and the haircut, right? So with probability 1 minus B, the project is actually successful, in which case the M dollars of borrowing will result in low M times low minus R dollars of net return for the borrower. With probability PB, the project fails, in which case the collateral become possessed by the lender. The lender will sell it, receive R, but then have to, from the proceedings of that R, have to pay back 1 plus R times M, right? 1 plus interest rate times the amount of borrowing, up to, of course, 0, right? So basically, if R is smaller than 1 plus R times M, the borrower will not get anything from the collateral. Okay. Lender's expected utility can be written in this, and the competitive equilibrium repo contract is basically this pair R star H star that maximizes borrowers' expected payoff, subject to the lender not making losses. Okay, and then that's the solution to that problem. Chabatarov categorized it to be related to basically you can determine H star and R star in this maximization problem. And it turns out that it will be H star will be related to VAR, basically, which is related to the distribution of the collateral distribution F. Okay, and alpha is related to the net present value ratios between the borrower and lender. Okay, this is where the divergence in belief will determine this value at risk probability percentile alpha. And then interest rate will be determined through this, right? So I'm going to skip this, but basically there are a couple interesting comparative statics. Equilibrium haircut will increase with the collateral risk as measured by value at risk or expected shortfall. Expected shortfall here is is basically conditional on the return being lower than what's needed for the lender to get the principal back, what will be the expected loss of the lender? Okay, so equilibrium haircuts will be
5 minutes,
increasing
Hanming.
increasing the loss. Okay, increasing in the expected shortfall, increasing in the value at risk, and increasing with counterparty risk as measured by rho. Right, rho is the return of borrower's projects. So the lower the rho, the worse the project is. Right, so the haircut will go up. The higher PL, lenders perceived probability of failure being higher, then the haircuts will also be higher. And I focus on haircuts because the equilibrium comparative statics in terms of repo rates actually goes in, the signs are actually going in not as clean as the haircuts. Okay, so come with the remaining 5 minutes. Let me just talk about what we do, right? So we exploit this data set to build a bunch of regressions, essentially. Let me just tell you, okay, I'm gonna skip these things. Okay, the sample period, as I mentioned, was January 1st, 2019 to April 30th, 2020. Within the sample period, we have the two events I've described, and when we do the subsample analysis for the two event studies, we'll be using the time windows around the event date. Event date for the first Fosun Bank takeover is May 24th of 2019, and the COVID outbreak is January 7th of 2020. Okay, and information mostly coming from Chinese financial, foreign exchange trading system, but we also use data from WANG and the China bond index. Okay, we create some liquidity measures, and we create lots of dummies for bond rating, bond type, and bond trading counterparty dummies. L2S means this is a trading. This is a repo with money going from large banks to small banks and so on, right? And the transaction between large banks, L2L, is used as a control group. When we talk about bond type, the omitted category is treasury, and when we talk about ratings, the omitted category is AAA. Okay, the number of transactions. These actually number of bond level observations, right? Because a collateral basket can consist of multiple bonds. So there are about 6.7 million bond level transactions, bond level repo haircut rates in our data set. In terms of the number of repo transactions, 3.1 million. Okay. Okay, impact of collateral risk on haircuts. This is the specification we control for the liquidity measures, both at the price and the transaction, and maturity, rating, bond type. Share IJT is the share of bond I in transaction J, right? Because this transaction J can consist of multiple bonds as a collateral. Valuation of IT, valuation, this is the dummy controlling for whether the discount rate is capped at 100%. We control for the transaction fixed effect, ADA-JT. And so this is within where the identification is coming from different bonds within a repo transaction. When we look at the impact of counterparty risks, we will be using this specification. Okay, running out of time, collateral risk. I will not go through these numbers in great detail. Basically, a lot of the findings are consistent with what we expect. For example, haircut is increasing in the illiquidity measures. Like lambda is a price illiquidity measure. Lambda T is a transaction volume illiquidity measure. They are all increasing. Haircuts are increasing both, of course, relative to the default category of AAA, AA, and AA plus have higher default, and so on. Okay. Counterparty risk, we found that this is the puzzle. The small to small bank to small bank a repo transaction has the lowest haircuts. Let me just quickly talk about one example of how we look at a particular shock affecting the haircuts. Okay, so this is basically the interacting of these relevant maturity rating and bond type with the event post dummy. Okay, so what we found is this is the Boston Bank takeover example. We found that all lenders will increase haircut on non-bank borrowers after the Boston takeover. Large bank lenders increase haircut on small bank borrowers. Non-bank and small bank lenders decrease haircuts on small bank borrowers. This again is puzzling. Why upon the takeover, non-bank small bank lenders in fact reduce the haircuts? Okay, let me show one more thing before I conclude. The COVID outbreak. So we were looking at different industries, of the the corporate bonds. So this is only looking at the corporate bonds, transactions where corporate bonds are being used as collateral, and we know for these corporate bonds which industry is the firm that issues the corporate bonds in, right? So we found, for example, industries that are involved in trade, transport, storage, and post, services for households, repair, manufacturing, construction, and information transmission. These corporate bonds issued by these firms in these industries saw increase in haircut compared to other less pandemic sensitive industries. So I'm going to conclude here. We are at a very preliminary stage. We have large a number of tables and figures that kind of provides a good overview of the Chinese interbank repo market, and did some regressions, tried to see how the haircuts are related to collateral risks and the counterparty risks in China. I will stop here.
Thank you, Arvind.
Thank you for having me on this interesting webinar series. I kind of applaud the work that Hanming and his co-authors have done. They have a really interesting data set on the Chinese repo market, and they've begun to analyze it. And you could sort of see Hanming has just begun to show you the results. In fact, I don't think he showed you everything that he's done in the paper, and you really need to dig into it to see everything he's done. So there's a lot to learn here, and I've enjoyed reading it in part because I've learned a little bit more about the Chinese repo market. So let me just jump right into it. And you'll see that the nature of my comments often are in comparing what is happening in the Chinese repo market and this data from my own knowledge of the US repo market, and particularly the TriParty market. And so as I go through my discussion, I'm going to make that comparison in a number of places. So first of all, this is the repo that they are looking at. They're looking at what is known as pledged repo. It's one in which the repo buyer has possession of the collateral, but not ownership. Okay. And at the end of the term of the repo, the pledged collateral is returned to the repo seller when the conditions of the repo agreements have been satisfied. Conditions being satisfied means you pay the guy back. It is important to notice there's no ownership transfer. You know, normally when we use the word repo, we're actually in the US context, it's a repurchase agreement. I sell you the collateral and then I simultaneously agree to buy it back from you in the future. It's a repurchase agreement in which the collateral changes hands. And for example, the lender has the collateral that it can do something with. It could use it to post as collateral for another transaction. It can borrow against it. It can rehypothecate. In the pledged repo, that's not the case. This is you get the collateral, but you just sort of hang on to it and keep it as long as there's no default. I emphasize that because I think that tells me that the repo is doing something different in this Chinese context as it is in the US context. For example, I think of things like rehypothecation, the ability to use collateral, as indicating that the repo contract in the US is moving collateral around in a way that, say, is related to moneyness. You know, when you talk about rehypothecation, you're talking about velocity and how stuff gets moved around. That is not the case here. In fact, what this contract looks to me like is it looks like a mortgage loan. You post the collateral, you get credit against it, and as long as you repay, you get the collateral back. Otherwise, the lender liquidates. This looks exactly like a mortgage loan. It doesn't have some of the characteristics of the TriParty or the repo market in the US, where there's much more of a money flavor to the way the contract is set up. And in fact, there is the what I think of as the standard repo agreement in China, but the fact that Hanming mentioned is that this contract volume is about 20 times the other, which means that apparently repo is primarily used for secured financing. I think that's the way to think about this. Okay, so let me just run through this. I think Hanming ran through a version of this model, but maybe my version will be easier. At least to me, it was easier. So this is, just think about a lender pricing a secured financing, effectively a loan collateralized by securities, right? P is the probability of default. L is the loss on the collateral in the case of default. R is the required return for a lender, so required return on a riskless loan. H is the haircut, and I is the repo rate. If you manipulate things a little bit, what you find is that the spread that the lender will ask for above the riskless interest rate, I minus R, the repo spread, is roughly proportional to P, the probability of default, and a term that reflects the coverage in default, how much the collateral will lose, but compensated against how much haircut is being posted. Okay. So graphically, that suggests that there's a set of contracts that a lender will be happy with in lending to a borrower, determined in part by the interest rate on the repo spread relative to the riskless rate, and the haircut. So for example, if you set the haircut high enough that you cover all losses in default, then of course the lender should be happy with a zero repo spread. That is effectively no default premium. But as the haircut falls below the loss given default, the liquidation value of the collateral, at that point, the lender is now taking credit risk and you need a bit of a repo spread. Okay, so this traces out a schedule that lenders and borrowers have to choose in setting haircuts and interest rates. So you can just do a couple of comparative statics on that. For example, if the risk of the collateral rises, so L goes up, what does that mean? It means this whole schedule is basically just pushed out. Repo rates have to rise unless haircuts rise to compensate for the increase in haircut collateral. You can also ask what happens if counterparty risk rises. Counterparty risk in this case is if this probability of default P rises. Well, the whole schedule tilts upwards so that for any given low haircuts collateral, it'll be the case that repo spreads have to rise. But if the haircuts, of course, are large enough, then the probability of the counterparty risk is not so important. So there's an interaction effect here between these two. I kind of run through this contract and emphasize schedule because one of the things that I think is of central interest from a research standpoint is how do borrowers and lenders choose points in the schedule? And what does the schedule tells us really that lenders are indifferent really between any point in the schedule. Why is it that particular points are observed? For example, in the TriParty repo context, very often the point that you see is a point around here, one in which repo rates remain relatively low relative to riskless rates, but in which haircuts completely compensate for the losses and the probabilities of default. And that seems to be a pattern in the US context. I don't think, as I'll show you, that's necessarily true in the Chinese context. And that's interesting because it says that there's something else going on. My own sense is it has something to do with the fact that this is secured financing and not a money collateral as it is in the US context. All right, so I'm going to walk you through this data. I'll probably highlight some figures that I found particularly interesting. And then the paper does this thing. It tries to use these two events, the Baosong Bank takeover and the COVID-19 shock, to disentangle separately, effectively, these two comparative statics I went through, counterparty risk and collateral risk. And I am actually not persuaded at all that this is working the way the authors would like to. And partly, here's the issue with COVID-19, that both collateral risk and counterparty risk are rising. So it's not a particularly clean experiment. The Baosong Bank takeover, I think, is a much cleaner experiment because, and my understanding of it is this is an action by the Chinese central bank, which effectively meant that a number of financial players were unlikely to be supported going forward. That sounds more like counterparty risk, but I'm not completely sure because I could easily imagine that also implies that the debt of some of these some of the securities that are being traded in the repo market are now have higher risk. So it's not as clean. I would love to understand more about how clean this is, sort of how good this identification is. And I'm afraid I'm just not the expert in the Chinese capital market to understand this well enough. So I will ask I think the authors could really dig into this more, because particularly there's some interesting stuff that happens around the takeover that you could say more about. Okay, so here is the volume data in this repo market. And there are a couple of things that are interesting. So first, as background, in the way to think about the US TriParty repo market is it's money market funds or cash rich, right? Households, corporations pool cash in money market funds. They're largely passing that cash through the repo market to securities firms and banks. So that the repo is effectively like a cash deposit market for money market funds. That I think is not the case when I look at the Chinese market. And I'll note a couple of things. The big lenders, for example, are state-owned commercial banks. And as Hanming made clear, what is that? That looks like the Chinese central bank passing cash to the state-owned commercial banks, which are then passing cash on to others, for example, mutual funds, who are taking a leveraged position, or small banks who are using the financing to buy other assets. And really in the context of the Boston Bank makes very clear, using some of the financing to take potentially very risky loans or gambles that maybe the central bank looks down on. So this is secured financing that looks like corporate finance from the central bank through a set of state banks to the broad financial sector. That looks very different than the way I think about the US repo market. I mean, here's the other set of lenders, policy banks, who are also funneling cash to the rest of the market. So to some extent, this market is, from the borrower standpoint, really a source of leverage to potentially gain leverage to take investments or do things with money. It's also a way, you see that many banks show up in both places here. It's an interbank market. It's a way of reallocating liquidity within the system. I think it is less a cash deposit market, which I think is the primary use of the TriParty repo market, which is a cash deposit market. That's there, but since the cash that's coming here is coming from the central bank, that doesn't look like that the world needs enough safe assets to satisfy cash needs. That looks like a different market here. The underlying collateral is looks to me like fairly safe bonds, treasuries, and policy bank bonds. There's other stuff in here. Corporate bonds, interbank deposits. I thought that was quite interesting, that interbank deposits are frequent collateral in the repo market. And from some other data, that looks like that's being used a lot by the smaller banks, which also is suggestive that smaller banks are using this as a way of financing to take some other investment opportunity that might come their way. The US repo market is basically government bonds. It's treasuries and agencies. Pre-financial crisis, I'll show you a picture. There was other sorts of stuff, but it was small and it disappears very quickly. Maturities, mostly overnight, a little bit at 1 week, very similar to the US repo market. It's a very short-term borrowing market in this case. I am curious why that is. If I put the lens of this as secured financing for a collection of institutions, why is it that they decided that most of the financing needs to be 1 day? Why not 7 days? Why not 30 days? Mortgage loans are, after all, 30 years or 10 years. Why are these terms of contracts, particularly the ones being used? That, to me, is a question that I would love to have answered in looking through this data. There's another side of the fact that the contracts are overnight, and this was a picture that I found very striking. This is the repo rate on these loans by the term of the loan, right? And if you just start off over here, the black line here is overnight repo. The red line up here is 2-month repo. That gap here is about 1.5%. That is remarkable. And in fact, if you even look here, this is the 1 week rate, which is about 1%. That says that in this repo market, if you want to borrow on a 1 week basis, you're paying a 1% premium overnight. That's like a massive failure of the expectations hypothesis. There's a huge term premium built in here right away. this is the Baosang Bank takeover when it's clear that risk in this market goes up. The overnight rate falls, the longer term rates rise. These spreads widen to like 4%. That's just enormous in a short period of time. If you look at US TriParty repo rates, you see a similar maturity picture, but the numbers here are like 5-10 basis points. They go up a lot in the fall of 2008 when Lehman fails, but when I say a lot, I mean like 2% or 3%, which I thought at the time was a lot. I look at these numbers and these numbers just blow me away as a normal state of affairs of having such a high term premium. Again, that feels like something that needs to be understood. Why is this market sitting here with such a maturity premium on overnight securities? Repo rate variation. Well, I took you through that model in the beginning. There's a schedule of repo rate against haircut, right? That's the way to think about it. And that schedule is in part determined by things like the counterparty risk and the risk of the collateral. It is the case, apparently, that to a large extent, repo rates across borrower types are about the same. So counterparty risk doesn't seem to show up in rates. I'll show you in a second. It seems to show up in haircuts, but it doesn't seem to show up in rates. For whatever reason, rates are about the same by collateral. Again, it's odd. Rates are not the same by maturity, but the rates are about the same by collateral class, by counterparty. This is rates by different types of collateral. And here again, you see fairly sizable differences. Going the lowest numbers here are for treasuries, the highest number here are for corporate bonds. That's like a 1% gap. So this market is discriminating not so much based upon borrowers, it's discriminating a lot in terms of interest rates based upon bond type. Interesting point. I don't understand why that is. In the US repo market, you'll see preference pricing for repo pricing for treasuries, but I think a lot of that is because the preference repo pricing for treasuries has to do with the fact that rehypothecation of treasuries is very valuable. So people like to lend against treasuries and park cash because they can get the treasuries and do something with it, and they're willing to pay for that option value of rehypothecating treasuries. There's no rehypothecation possibilities present here. This is pure secured financing, and yet we're seeing quite different repo rates. Why? I'm not entirely sure. Question for the authors. Here are haircut changes. Again, on the left side here, this is across borrower type, and there are fairly sizable haircut changes over this period. I guess as risk is moving around, particularly when this Baosang Bank takeover happens, risks move around and haircuts move. Again, repo rates apparently didn't move, but haircuts move. So in choosing that schedule, the market seems to want to move haircuts here, but not rates. Why? Haircuts also move by bond type. So we saw earlier that by bond type, both interest rates were moving. Now we see that haircuts are also moving. Again, kind of an interesting pattern. It's without doing a little bit more analysis, it's not entirely clear how to translate these movements in haircuts to interest rates, right? And I showed you at the beginning kind of a graph of a schedule, and you need to know the sort of the slope of the schedule to understand how this trade-off is happening between interest rates and haircuts. And it'll be interesting to understand whether these changes here are really kind of quantitatively important or if they're small. And that's something that I think their analysis can shed some light on. Total volumes over time. So this is a large repo market in which there's lots of borrowers and lenders who are trading repo. I have to say, one of the things that I found striking was that volumes are relatively stable. They really remain.
5 minutes, at most 5 minutes.
Perfect. I'll be done in 5. But volumes are remarkably stable over this period. In fact, even the shock that Hanming mentioned, which looks like a big shock in terms of rates and haircuts, doesn't look like a big shock in volumes. It continues. The secured financing market seems to continue despite what's happening. And that could be because of borrowers, it could be because of lenders, but it's just an interesting fact. There's stuff that's happening around COVID in which volumes are moving, but then if I showed you some of the other pictures, volumes don't seem to be moving. Sorry, interest rates and haircuts aren't so much moving over COVID. They're really moving around this event. Again, question why. And here's a last graph that I found very interesting. This is how collateral composition is moving in the repo market after the Baosang back takeover, which looks like a pretty significant shock in this market. And I think the only thing I want you to look at is all these lines are about flat, which means nothing is happening. Volumes are about the same. Collateral composition is about the same. Let me just draw a contrast to things that happened around the global financial crisis in the US repo market. This is, in red line, the quantity of repo against non-agency mortgage-backed securities and asset-backed securities, which of course were at the center of the financial crisis now 13 years ago. And that volume collapses quite dramatically. In fact, if I draw this graph going forward into 2010, 2011, it's basically zero. The shock just kills volume completely, quite a bit different than the data I just showed you, where volumes look like they continue and prices seem to adjust to keep the market going. Here's another version of this. This is these are haircuts in the repo market around this Lehman failure. And you'll notice here haircuts and treasuries and agencies remain very constant. There's actually a gap in haircuts in private ABS. And the reason for that is because there's no transaction volume. When these securities start to look risky, the lenders just walk away from it completely. Here's the same graph in terms of interest rates, big spike in interest rates against corporate bonds and against ABS, almost nothing happening in agency and corporate space. So there's an aversion that's showing up that pushes up haircuts, pushes up interest rates, but also causes volumes to collapse against some of this risky stuff, a pattern that we don't see in the Chinese repo market. I'll skip this. And then here's just another thing that I think is interesting. This is the Lehman failure, which at some level is the types of things that are happening at Baosang Bank. And this is repo for Lehman, which looks like a bank run. It's sort of going along, and then it drops to zero. And this is in days. So from September 10th to 18th, the volume of lending to this institution just disappears completely. All right, so this data I found really interesting. I don't have a clear picture on what it is, and in a way, my ask to the authors who have such great data is to try to explain to us what this market is doing. The way I've thought about the US repo market is it's really all about the lenders. It's a cash money market. I'm very much influenced by the work of Gary Gorton, along with Tri Dang and Bengt Holmstrom, who basically think of this market as it's a market for informationally insensitive assets. The lenders in this market are skittish about risk. They don't really want to take too much risk. As soon as they see a bit of risk, they disappear. They're adjusting interest rates and haircuts and do all of that stuff to kill risk. And so in the schedule that they're choosing, the points on the schedule, they're always choosing points in which they're eliminating risk completely. And if risk starts to look like it's getting too high, like it did in the ABS market, they just back away and say, we're not touching that collateral at all. If you're a questionable borrower in the US repo market, you're basically shut out right from the beginning. You don't have access, which I think is not true in the data that you just showed us. China looks very different. Volumes and compositions are stable. There's lots of participants with widely different credit risk. There's lots of different collateral. There's lots of repo rate variation across this market. And I think the research question that I'm left with is why? What's determining these repo rate, haircut, quantity triple that we're observing in the data? What type of theory that we need to understand this? One possibility, and this is just pushing on this point, that this looks to me very much like secured financing. It looks like, say, a small bank or a mutual fund is taking leverage, is taking financing against it, using the cash to do something with. That looks much more like a corporate financing decision. In fact, I could almost think of this as there's a firm, it needs to raise financing, it could raise unsecured financing, it could raise secured financing. It's going to use those proceeds to do something, for example, pay dividends back to shareholders or take some investment opportunity or risky loan. There's a, you can, if you put the framework of a corporate financing decision, maybe you can try to make sense of this. So perhaps the trade-offs of choosing things like rates, haircuts, collaterals, and quantities are about questions like, what are my alternatives to raising secured financing? Maybe I want to raise unsecured financing. Maybe I want to raise equity or long-term debt. Maybe as a borrower, if I go out and pledge my collateral in the repo, then I'm encumbering the asset. Maybe I don't want to do that. Maybe I'd rather not encumber the asset and keep that flexibility for the future and rather raise unsecured financing. It would be useful to bring that corporate financing perspective and think about, say, alternative financing options, and maybe that helps us understand some of these patterns and why haircuts and rates are moving as they are. Zhiguo has worked with Peter, who think of collateral as a way for commitment. Maybe that's important in this case. I can certainly believe for the number of these borrowers that commitment problems are severe. I mean, in fact, the event that is focused on this Baosang Bank indicates that risk shifting is sort of an important factor in how decisions are being made, which surely must affect the form of financing and the way in which financing has happened. So it would be nice to kind of bring that into bear. I wondered if the question that you raised repeatedly, which is the puzzle of the small banks, which is they have small haircuts, maybe that's because they're paying high repo rates. So kind of thinking of them together maybe gives you some answer to this. And then the last thing I'll mention, I've pointed this out earlier. I have to say that the term premium observation is really puzzling to me. It's very interesting why there's such a strong lender preference for overnight lending. Some of the movements around the Baosang Bank crisis are also really interesting. And I know there's things that the Chinese central bank did around there and flooding the market with liquidity that probably had an effect here. There's almost kind of a separate paper that one could write just looking at movements in term premium related to risk and related to central bank actions around here that I think would be instructive. So I think I'm done. Yeah, I'm going to stop here. And
thank you.
Thank you.
Thanks, Arvind. Hanming and Yongqin, do you guys wanted to respond a bit? There's a lot of questions.
No, thank you, Arvind, for great suggestions and the connections and the contrast with the U.S. TriParty repo market. I think these are great questions that we will have to digest and think about posing a more clear, maybe a question that can help understand exactly what is a Chinese. I think the way you think about it is secured financing very different from the U.S. repo market. I think that distinction is very important for us to draw, and maybe the questions you highlighted about the repo rate maturity premium. These are things that we should first of all look at the data more carefully to make sure that these facts are indeed facts, and then if they are, then I think it's maybe these are better questions for us to focus on. Then right now what we are trying to do is to use the two events as some way to proxy for either the counterparty risk for Baosang or collateral risk for COVID. I agree with you that COVID event is not a clean experiment. I think everything is going on in COVID, including counterparty risk as well. So yeah, so I very much a lot to digest, but thank you so much for the questions and the suggestions you make to us.
Hanming, I have one simple question. Do you know why that in China it's the pledged repo way more popular than this one? It's called a 买断式回购, where you just bought it.
Right, outright repo is very small. Right. So Yongqin or Xian, do you know the answer? I mean, the data is just like that, but is there an institutional reason for the pledge repo to be so much bigger? Xian, do you know the answer? Xian is in the audience, right?
Yes, I'm here. I'm sorry, I don't know why there is so much pledge repo than outright repo. But I think maybe pledge repo start earlier than the outright ones. It's used earlier. and
You mean that market starts
I-
way earlier, and then you think it's just it's a matter of time?
yeah, I haven't looked into that, but that's a good
Okay.
question. I'll check
Yeah.
some official documents. Thanks.
Bernie, you want to ask something?
Yeah, I want to thank Hanming and the authors and also Arvind. I'm the uninitiated, and I learned a lot from this. And the presentation and discussions motivate me to read more about the paper. Thank you very much. And the literature too is very exciting. I have my two very naive questions. One is like, what is the purpose of repo? If we are thinking through this as the corporate finance decision, why would companies or why would these banks raise this very short-term borrowing? What's the purpose? And the second thing is that what do we speculate as the difference between really fundamentally in the capital market development between the Chinese repo market, as we see, and the Americans?
Okay, so the first question, again, Xian, you can add if I said something not right. My understanding is that, like Arvind was mentioning, my understanding of the picture I showed of the central bank interacting with the state-owned commercial banks and the policy banks through these lending liquidity facilities, and then the interbank repo market is a way for the liquidity to kind of to move within the system from the big dealers, right, the big commercial banks and the policy banks to the smaller financial bank or non-bank financial institutions that will be interacting with the real economy through lending and so on. So yes, I somehow felt like the Chinese interbank repo market is more a way of a kind of a monetary policy tool instrument than the U.S. repo market. I think to describe the U.S. lending market is about lenders, right? The small cash rich pension funds or depositors pull money together. They want to they are not in the they want to basically look for some returns to these to their cash without having to incur any overdue or excessive risk, right? So, and they are very averse to risk. Here, I think, again, I have to read more of these institutional backgrounds and the way the policy documents related to the establishment of these of China's interbank repo market. My understanding from the way my current understanding that it's more about a mechanism, monetary policy kind of transmission market than for these kind of organic kind of growth of the repo market in the U.S. I mean, is it correct that in the U.S. the repo market you were talking about is organically grown, have nothing to do with the Federal Reserve?
I mean, the Federal Reserve has acted in it at various times to stabilize it because it's an important market for security market functioning and for reallocation of liquidity. But yeah, it's an organic market. It's a It's a market that I think started as an interbank market for reallocating liquidity, but really takes off, I'd say, probably 1980s onwards, with the rise of securities trading, the rise of money market funds. So it's very closely tied to financial development broadly. And I think, Hanming, the way you're describing it, this is tied very much to the central bank's desire to parse out liquidity into the system, which seems different. Yeah.
Right. So I mean, I will double check, make sure that these understandings are correct. But my current understanding is that the origin of the two markets may be quite institutional origin of the Chinese interbank market may be quite different from the U.S. The U.S. repo market, and maybe that might have might play some role in how the two markets now are quite different in terms of the way they function
so is it right for me to think? Is it right for us to think about that the repo market is an organic device to deal with the liquidity and to enhance the liquidity in both. But there's something additional in China. And if that's the case, what kind of liquidity we're talking about when it comes to corporate finance?
So Xian, you can add if I, my understanding that they need this interbank repo market to manage, capital requirements, things like that. Is that right, Xian?
Well, I think the interbank repo market is a market for financial institutions to meet their liquidity needs. So, but for corporations, for firms, the repo bond is more seems to me more like acting through the price of the bond. The transaction in repo market can affect the haircut of the bond and therefore the price of the bond, and that can affect the financing of the corporations. However, corporations, non-financial corporations, cannot participate directly in the repo market. Only the financial institutions, including the banks and mutual funds and some other financial institutions, can directly participate in the repo market. But I think repo market can act like through the haircut and affect the price of the bond and indirectly affect the financing of the firms. Yeah. And
So Bernie,
that's my.
yeah, let me just reiterate, it's basically interbank markets are like direct corporations in your usual way of like IBM or Apple. No, they cannot participate. One of the big, very important participants that are connecting the real side with the financial institution are these so-called rural banks or city commercial banks, all these things. They call the small financial institutions. They are at the lower end of the liquidity layer, and they could issue this so-called interbank deposits that Arvind was talking about. And then once they get the liquidity from the PBOC through the long chain, they are able to lend to these corporations. It's very big.
Then wouldn't I observe the same in the US? There are many small banks in the US.
Indeed,
right?
indeed. But you see that this channel,
I
it's
would
really
say that there's this difference between the US and China. So that's the thing that raised my curiosity.
I was going to say that the volume in the US, the bulk of the volume is basically money market funds to security dealers. And you can count the number of banks that are involved here. It's like 30. There's another part of the market for which there's less light on, which is attached to prime brokerage, which is the security dealers have prime brokerage operations lending to hedge funds. And they're also lending repo. And that allows the hedge funds, for example, to speculate and do things like that. That sounds similar to this situation, but also sounds very different because, as both Zhiguo and Hanming made clear, it seems like these small rural banks are taking the cash and, I don't know, making a loan to somebody, not necessarily doing the long-term capital, buy 30-year bonds and short 29.5-year bonds. That's not what the liquidity is doing. It's doing something much closer to the real economy. Is that is that fair?
There are also these, I think so. But there are also these hedge funds are also players in the market. That there, I don't know how much the volume of by the of the repo transactions by to the hedge funds. How big are they? I guess they are not the biggest.
You had one data point which sounded like it, which is the mutual funds. In fact, that was one of the things that surprised me, that mutual funds are repo borrowers here, which means they're taking leverage. So you have that almost sounds like the repo is being used by different players
for different purposes.
for different
For
purposes.
different purposes,
So
right.
if I put now a kind of a corporate finance theory hat on, I would tell it would mean to me that the terms that would be right for the mutual fund should be different than the terms that should be right for the rural bank.
I see, right.
Right.
Because
and then it would be
they are being used to finance very different.
very different things, and they probably want some different maturity, haircut, rate, schedule.
I see.
And maybe you can explicate exactly how that's
Okay.
happening
Think
and why
about
that's happening.
Baoshang is one of them.
Yeah, Baoshang is one of these guys, right?
Yeah, yeah.
Seems like a risk shifting bank is the way I read the news stories. Right? Is that fair?
Yeah, there's a other political crackdown going.
I see. Okay.
All right. I think thanks, Arvind and Hanming. Today's talk.
Zhiguo.
Yeah. Oh, Yongqin. Yes, you want to say something?
Yeah. Actually, I was in the way on the way to Wuxi, so it's not in the office. So it's a little bit of background noise maybe. Still, I back to the question why pledge the repo dominance. I think one reason, there's two reasons. One is that for it's accounting and regulation requirements is more complicated for buyout for repo, because it needs to do some adjustments in the balance sheets to have more risk provisions for the capital requirement. So I think the financial institutions are not willing to do not have much incentive to do buyout repo compared with the pledge repo. It's easier, more standardized, the more much less regulatory requirements like risk provisions. This is number one reason. Number two reason is related to Zhiguo's idea of commitment, because in China, if you have a buyout repo, the counterparties may default. It's easy to easily not buy back, repay, because it's a buyout, right? It's a deal. The deal finished, then it may not honor the promise. But it's a pledge repo. It will, it's easier because the ownership is still in the hands of the counterparty or the borrower lender, right? So the other way is this relates to the institutional environment. In China, legal enforcement is not as strong as in the US. There's two reasons for that. There. Thank you, Zhiguo. And thank you, Arvind, for the wonderful discussion.
Thank you both. Bernie, you want to announce the next seminar?
Well, again, I want to thank the author and the discussions. Characteristically, this workshop has helped us to learn a lot about what's happening in Asia, and the comparison between the US, the developed market, and Asia really is particularly educational. I want to thank you all. And this seminar is organized by multiple parties, including Chicago BFI, CUHK, Hong Kong and Shenzhen, and also the CIF at Jiaotong and Tsinghua. We have discussed among ourselves, and we think that it's better to space out. And also, there's some requests of the authors that the next round will not be on August 14th as planned, but it will be delayed. And we are going. The next round will not be August 10th as planned, but it will be postponed to next year. So the next seminar will be on August 26th, and the title is "Special Deals from Special Investors: The Rise of State-Owned and State-Connected Private Owners in China." And the authors are Michael Zhong, Qing Tai-Se, and Bai Zhongen. So we look forward to the next one on August 26th. Thank you very much, everybody. I really enjoyed the presentation, the discussions, and the Q&A. And thank you, Zhiguo, for moderating. Thank you, Hanming. Thank you, Arvind. Thank you, everybody.
Thank you, Arvind.
Thank you very much.
Zhiguo and Bernie. Really appreciate
thank you
the
again.
comments.